Well, hey guys, we're here with Carl Milberg, our manager out in Las Vegas, Nevada. Thanks a lot, Carl, for being on the call with us. I know you've had some success with the temporary buy down program. So, what we're trying to do is get together with a couple branch managers and just kind of chat with you, what's been working, some wins that you've had. Maybe to start us off, you can kind of talk about the strategies that you've been using to bring up the temporary buy down initially, to your agents, to your buyers.
Okay, so let's talk about the agents for a minute. All the agents that I deal with, or any agents that's in my database I'm trying to do business with and whatnot, I've gotten them out the flyer. I put together Mortgage Coach that shows the 2-1 buy down, the 1-0 buy down, a permanent rate buy down, and no buy down at all, and what the cost of those are. I mean, it's a 2.5% cost of the loan amount for the 2-1 buy down, 0.8% will cover the 1-0 buy down. So I send out that Mortgage Coach to the realtors with the flyer explaining the buy down procedure. And then I created another Mortgage Coach presentation that when we're dealing with listing agents that works on net, and I'll ask the listing agent how much their commission is for the real estate contract. And the only thing I don't have in is the payoff of the existing mortgage from or any other liens that are on the property. But I'll put in the sale price that we're going in at, the commission that's going to be subtracted for the seller, and then minus the fees for the seller paid closing cost. But next to it, I show the price reduction that they would potentially have to do to make the property move faster. Now, if it's a brand new listing, it might not work so much, but a lot of these listings have already been listed 2, 3, 4 months, not much activity showing. So they know it's kind of a down market. And these listing agents are actually, when we have a purchase contract going out to one of these, they're getting me on 3-ways with the owners right away.
Nice.
And they'll even show them these presentations. Sometimes we don't even have to do that. So to go recap on this a little bit, any agents that I get in contact with, we're talking about the 2-1, the 1-0, no buy down, and the fact that the sellers would have to reduce the price more to get a buyer than they would if their sellers paid closing costs for the buyer. So that's been working really well. The flyer that's from Total Expert, making a Mortgage Coach and tweaking a Mortgage Coach just to show a net for a seller, it was really easy to do as well. Now, one of the hurdles with the realtors I got to make sure of, I got a purchase contract over now. We just sent out disclosures and they put down 2.5%, but just to be used towards rate buy down. And I needed to get an addendum because the buyers want to do the 1-0 buy down and then have the rest of the closing cost paid with the money. And instead of just because I told the realtor, I'm like, make it say that we could use it for rate buy down and closing cost,
Sure.
so we could use it either or. That's working really, really well with the realtors. A lot of them didn't really understand the difference on it. And the big one is letting them know, I don't do this with the listing agents so much or the sellers, but when you're dealing with the buyer's agent and a buyer, explaining all this, letting them know that that money is in escrow. And if they're lucky 8 months down the road or a year down the road and the rates dip and they could refi, or if they sell the house, the money that's still sitting in there for the payment difference will go to pay down their mortgage balance on the refi. So that's a big deal to realize that they're not going to be losing any money on that. I've had it both ways where if there's enough money on the table, the buyers love the 2-1 buy down. Yeah. That's phenomenal. But doing the 1-0, I've got a purchase contract another one coming over today that's got 3 points on the table. So we're going to just do the 1-0 buy down, pay about half of the closing cost, but then do a permanent rate buy down as well. And it's a VA loan as well. So we're going to be looking really strong on that. So I've been getting really good feedback on it. Now, when I have clients that are pre-approved and they're out there making offers, every offer that gets sent in, I'm getting CC'd with the listing agent on it, but I get a hold of them immediately to start explaining why the offer is what it is. And my realtors have been doing a really good job comping out the property, kind of seeing what the value is. And unless it's still somebody that's in la la land, I don't think we'll have any problem with appraised values because we have comps that are higher as the values have been going down. So we're getting the values in, and this helps prop up and keep the values up in a neighborhood. So when I talk to the listing agent and explain it to them, every deal that's come in so far, the listing agent either went over to their seller's house and got on on a speakerphone with
Yep.
me on the phone, or they put them on a three-way call and we were all on the phone together so I could answer questions. And because some of the pushback would be like, well, yeah, we'll be happy to give 1 point, or we're doing a VA loan. We'll be happy to give 2 points, but not 2.5. And I'm like, but the 2-1 buy down costs 2.5 points. We need that much. It can't even be paid by the realtors. And the realtors like the fact that when I'm talking to the clients, whether they're the buyers or the sellers, I'm not stating that a portion of that can be paid by the realtors because they don't want us to get into their pocket.
Sure.
But I do mention it to the realtors when it's just me and the realtors talking. And then when I'm engaging the clients and talking about it, I think they really like the fact that I'm not putting them under the bus that they could throw in their own money. The only time I haven't used the buy down money is when I've done a conventional loan and the credit score was too low. It was so much of a cost for rate. We just used it all for the rate.
Sure, sure. Would you say that, because it's like you said, it's still fairly new, but the buzz is kind of out there. Are you having to explain to your borrowers and agents how this works, or do they kind of understand, but you just kind of fill in, maybe a few questions?
Well, no, what makes it a no-brainer is that mortgage coach presentation for a price point. So $500,000 purchase, 5% down, or VA loan, 100% financing. I send that to the realtor and it's got 4 loans side by side, same sale price, 2-1 buy down. And in the heading, it says seller paid 2.5%. So we can't list that sheet on the closing cost. It would take away the cash out of pocket. So it's listed in the heading on that loan. So that's one loan, 2-1 buy down, seller credit 2.5%. 1-0 buy down, seller credit 0.8%. And then permanent buy down using 2.5% seller credit. Now I price that out. And in that loan, it's a seller credit to buy the rate down permanently. And then the fourth option is no buy down at all. So now I send that mortgage coach to the realtors, to the clients, hey, get in there and let's talk about it. Now it starts making big sense for them.
So what percentage of the offers that go out, because it sounds like, even before the offer's made, you're talking to the borrower, you're talking to the buyer's agent. What percent of the offers that are being made for your clients are requesting
100% right
okay.
now.
Yeah, that's what it sounded like. That's great. Okay.
Well, and when I talk to potential buyers, and they're kind of on the fence, well, the values are coming down, but I'm like, guys, terms are more important than whether the rate comes down or the value. You can always refinance. Now, for everybody else out there, if you're doing a VA loan, you always have an ERL on the table.
Mm-hmm.
So I recommend to the client that we should even push the rate up as long as we're not going over what's allowable for the contribution. We should push the rate up to give origination credit for closing costs to do the maximum buy down for a client. If there's 2.5 seller paid credit, we should push the rate up on the perm side to give them 1 point origination towards their closing cost as well. And when I show the clients this, and I'm like, then you're poised, now you're getting 2 loans for 1 as an LO, because after 6 posted payments, because you push that rate up, even if rates stay the same way they are now, you're going to be able to do an ERL. And FHA works the same way. I'm trying to push them down a 3-step, push the rate up, do the buy down, do an FHA streamline or FHA to FHA. So that's the second step. And the third step is when they go to 80% LTV, do a conventional loan to get rid of the MI.
Yeah, no, absolutely. Are you hearing any common concerns or objections as you're, explaining the program to, the agents or the borrowers?
No, but some of the concerns are when the nice thing about the FHA and VA, they have the streamline and ERL feature when rates go down, but the conventional loans, they're like, well, what if rates don't come down? So now the one thing I tell the clients, and I'm like, this market's kind of weird and the values are coming down a little bit. And I tell them we really should have them come down because the escalation over the last 16 months was too much to bear. They should adjust a little bit, but so what? And when we qualify you, it's at your full rate. And as long as you keep your bills and your payments the same, that you're going to have your payment, whether it's a year down the road or 2 years down the road, as long as you don't live up to your money, which some people tend to do, now you're going to get in trouble when your payment steps up, because we're approving you at an affordable level right now at the full rate that you're going to have. So you got to keep your bills the same or even be in better position as the years move down the road. And we want to refi you the minute it becomes available. And I'm hoping in the next year, year and a half, I tell people that I personally think healthy rates could be in the mid-4s, but there's no guarantee they're going to come down and they could go up. Now, that's the one little pushback that I get yet. But when people stop and think about that, I mean,
I think it's a no-brainer too. Win-win all the way around. I mean, it eases people into home ownership, saving thousands and thousands of dollars. And like you said, from what I understand, back in the day, the borrowers weren't qualified at the full note rate like they are now. So people could get into trouble, when the actual note rate they started paying that. But yeah, I mean, it gets them in the house now, saves them thousands of dollars. Should rates go down, all that money left in that escrow account to fund the temporary buy down just goes towards a principal reduction, which again, I think it's still fairly new. So I don't even think a lot of people know that. So I agree with you.
Yeah, and that's what I tell them. I said, if you're doing a conventional loan, I really want them to be aggressive and do the 2-1 buy down, because if rates do dip down, but value dipped a little bit, the money that's still on the table could offset having to bring cash in to keep their LTV in the right position. I think they'll be okay on that. The other LOs out there, if they put together just a simple mortgage coach, but treat it as a seller's net and an offers out there for the client, ask the listing agent, hey man, do you know how much your seller owes on the property? And plug that number in there as a payoff. You should put in 2% for their closing cost, what the real estate commissions are. That's it, 2 things. And then the payoff. And they could show that, but they would normally have to reduce the price. I mean, you're right. I mean, the market is slow. Who knows how much longer we're going to have these available? Because if the market starts heating up, the sellers aren't going to pay it anymore.
Just curious, Carl, in your market, are you seeing any other competitors really pushing this like you are, or no?
No, not really. There's a few competitive, like Rocket, they have their own, and there's a few of them now that came out and said they do, we'll pay your interest for the first year type stuff. So they're offering a 1-0 buy down that's lender paid, but we're going to kick their butts on the rate when we do it that's seller comp. So they're not asking for the sellers to pay for stuff. But that's the only thing that's really being pushed out there. The clients that I'm getting over to me, I'm working a lot of realtor.com leads, so they're shopping around like crazy. They're not hearing this from any of the other lenders at all.
Yeah. So for people on, they're going to be listening to this, I mean, now is the time, because I mean, not a lot of people are investing the time to, number one, learn the program, and they're just not talking about it enough.
Well, and also right back to what I said a minute ago, the market will bear it. The sellers will pay this stuff. Sure. That's going to be the first thing that goes away.
Well, I love the fact, Carl, that you're leading with this, from the very beginning, getting on phone calls, using Mortgage Coach sounds like it's been huge for you. Any advice for either new LOs, maybe at RWM, or just loan officers that really don't have any experience talking about the program? I mean, it sounds like they just kind of have to get after it and really start feeling confident, at least throwing it out there and talking about it. It's becoming a little bit more mainstream, where at least it's not foreign. If you say, hey, buyer, hey, agent, it sounds like they've kind of at least heard about it. So it's not going to be out of left field completely.
Well, it becomes really simple when you're explaining the buy down to just simply state that it's the cost of the buy down is on the loan amount, and it's 2.5% for the 2-1 buy down, 0.8% for the 1-0 buy down. That becomes a no-brainer. And that's how it should be explained to everybody, because everybody understands seller credit, the realtors, and maybe most of the buyers have heard that here and there. But if you're going to do the 1-0 buy down, you need at least 0.8% contribution from the seller. Now, if you could do it off sale price and you're putting down 20%, that gives you a little bit extra money towards your closing cost. And it's 2.5% for the 2-1 buy down. Period. If you don't get it, you're not going to do the buy down. That becomes really easy. And then if they just have one mortgage coach sitting there where they could change the loan amount sizes if they want, or, I mean, you already see the calculator that we have at Encompass, but they should really set up a mortgage coach with 4 loan scenarios side by side that they could just go in and change the value on loan amount. But they should do that for a buyer that they could send over to them right away. That mortgage coach, 2-1, 1-0, a rate buy down and no buy down. They should have all 4 of those side by side. And that when they send it to any realtors or clients and start talking about it, it really answers itself to explain what's going on.
Yeah.
Hey, the cost is 2.5 on this. It's 0.8 cost on this. Here's the savings. Here's what the payment would be at the end of the 1 year or 2 years. I mean, it's real easy, and everybody understands that, and they really want to take advantage of that. And then anytime it's a government loan, I would stress to everyone out there, FHA, you should prepare somebody ready for the 3-step process. You want to be able to do an FHA streamline or the simple FHA refi. That's the second step. And the third one would be to go to the conventional loan to get the MI out altogether. In VA, you should prime them to do a 2-step, push the rate up, help cover their closing costs yourself so you can do an IRRRL after 6 posted payments. But the whole idea in doing the 2-1 buy down, I've had a couple of deals come over. One of them, like I said earlier, we had the buy down money, but the credit wasn't that good for conventional. But it leaves all the options on the table. When you have 2.5 to 3 points seller paid credit, boy, you can really hook your clients up.
Sure.
In a lot of different ways. And the sellers, when I've explained this to them and their listing agents on the phone, they're fully down for it because they're not getting any action on their listings. I have listing agents calling me up asking how they should put in their notes in the MLS that when other realtors, when they're searching properties, on what they should say. And I'm like, put down that your seller's going to give 2.5% for closing costs, and it could be go for a 2-1 buy down. And they're all doing that on their listings now.
No, I think that's great, Carl. Great commentary, good talking points. I appreciate your time, Carl. Like I said, this was fun, and I think it's going to be super helpful to all the other loan officers out there that really aren't even talking about the program because it's important. Because like you said, it could change. I mean, now's the time to talk about it.
Well, and something that I like to do, I like to schedule most of my close of escrows in the middle of the month or even the first week of a month so that somebody's not going to have a payment for a month and a half or a month and 3/4. And then if they're doing the government loan, I really want them poised to be doing a IRRRL or streamline after 6 posted payments. They're going to skip another month payment. If it's a VA, they're going to skip 2 months payments. You can't do that renting a property, skipping, 4 months payments in the first year, 12 months that you're there. That's pretty badass. You're really doing someone a lot of favor, and there's nothing wrong with us doing a couple of loans at the same time, but it really pencils out good for people. And I think doing that, we really bring a lot to the table for the clients. And I explain it to clients. Now, whether they do it or not, it's no big deal, but I want to plant that seed in there because I get a lot of referrals because of those type of conversations.
Yeah, I would imagine. Yeah, that's great. Again, Carl, I appreciate your time. Well, hey, Tony. Hey, Jeff. Thanks for taking some time today to kind of talk temporary buy down program. We're starting to see a lot of traction, and what we wanted to do is just kind of touch base with different branch managers in different markets, kind of see what's working, what might not be working. Maybe to start it off, you guys can just kind of talk about maybe some strategies on how you're even initially bringing up the temporary buy down program. Is it at initial application? Is it when they get into contract, maybe get on the phone call with the borrower and the realtor? How does that look for you guys?
For me, you know what, I usually bring it up to the clients at the initial application process. As we're talking about the loan process, I bring up the program and try to educate them on the program and how they can utilize this to their advantage.
What I do on the open houses that I'm having every single weekend is I'm talking to everybody about the 2-1 buy down because everybody's topic has been, well, how are the rates? Everybody asks about that all the time. And yes, the rates have decreased a little bit, which is good, right? But at the same time, we want to make sure that we're talking about what's on everybody's mind. And that is, hey, listen, I know that rates are higher than they've been in the past, but here's how we're tackling that. And then the conversation sparks with the 2-1 buy down, and the 2-1 buy down is wonderful. Once they get to understand how that works, I make sure that I'm projecting loud enough so that there's traffic walking around. I can see them looking this way. And so I'm being loud enough, right, to be heard by this person, that person. And then now the realtors have captured that. Now the realtors that I'm doing the open houses with, they're actually talking about it to everybody. Nice. So it's that right there is a very good way to talk about it. Now, we are going to miss opportunities. I had a client who recently I had discussed with the buyers the 2-1 buy down. They never asked about it again. They got into contract. I got the contract over the weekend, and on the weekend, on Saturday, I got the contract fully executed, but on Monday, they're asking about the 2-1 buy down. And I'm like, guys, you're already in contract. The seller's supposed to give you this money. So I'm like, how do we do this, right? So then the buyer's agent communicates and says, hey, we're requesting $10,000. So then the listing agent emails me and just goes off on me, says, hey man, you said that this buyer is approved. Now you're asking for 10 G's. So I called him immediately, and you could tell that he was upset. So after the conversation, he's like, you know what, man, I like the fact that you answered every question that every point that I said in that email, because I'm pretty upset, but this is the way we're going to get it done. And I told him how to get it done without telling him how to get it done. He then said, we're going to move up the needle a little bit, right? 10 grand. And then that $10,000 is going to go towards seller credit. He said, I still have to talk to the sellers, but I know I can handle that. I said, we're good to go. Needless to say, we closed that loan last week. So that
Nice.
was a big win.
Yeah, no, for sure. Yeah, one of the things I was catching up with Carl Milberg, talking about the program, and he is 100% all in. He strategizes with the buyer's agent, the buyer up front, and every single offer that is written is asking for seller credit up front. And he even goes above and beyond that just to make sure everybody's on the same page. And he even tries to get listing agents on the phone up front along with the sellers to explain the benefits all the way around. So yeah, but that's a good point. I mean, definitely want to make sure everybody's on the same page. Are you guys finding that when you're bringing up the program in general, it's been around now, that kind of made its comeback, 3-4 months ago. And I think we positioned it and rolled it out as quickly as possible. So we're kind of ahead of the game. But are you starting to feel like people are starting to understand it, or are you having to explain it from the ground up like it's like foreign to them completely?
I would say both. You get a mixed bag. There are certain agents that are a little more in tune to industry news that they kind of got a good handle on it. And there are certain people or certain agents or referral partners that they're clueless about it, which is an opportunity for us to connect with them.
Get in front of them. Absolutely. What about you, Tony?
I just ask, what have you heard about the 2-1 buy down? And if they immediately sound like they know, I ask them, I follow up with, what part of that do you not understand? Is there anything that is kind of iffy with you? Can I clarify anything? And if they're like, good, then why beat that dead horse, right?
Yeah.
But then if there's anybody, if I look around and I say, hey, how are you with that 2-1 buy down? How do you feel about that? And they say, I have never heard about it. I said, I'm glad, so that way we can talk right now. So it breaks the ice. Everybody starts asking questions. And so it's just a matter of asking. So people are going to know, people are not going to know, just ask away.
Yeah, exactly. For the people that, you've discussed the program with, and even for the loans that you've closed with temporary buy down, has there been any common objections or anything that keep coming up that you guys are hearing from either agents, borrowers, or even sellers?
At first, yes. At first, they were thinking more like it was an adjustable rate, something that is going to adjust down the line. But then you just got to clarify. No, it's fixed, right? It's a temporary fix. It's a temporary buy down. But this is not going to be fluctuating up and down on you. This is just what it is. You're going to get a 4.99. You got to get a 5.99, 6.99 by the third year. God willing. And I do say God willing. But I tell them in the next 24 months, we want these as soon as these rates go down, you and I are going to be talking.
Yeah, no, that's a great strategy. It comes down to really being, great communicators, not really selling the rate, but explaining to them how it benefits them. And, I've closed a couple myself, and yeah, that was one of the big ones. Hey, is it an adjustable rate? So you kind of have to explain how that works. And the other one too, people that have went through like '08, the kind of craziness back then, they just want to make 100% sure that in no way it's a neg am type, loan.
Right.
Those are the two big ones that the borrowers that I've closed, they've asked up front. But again, as long as, you explain it properly, and it hasn't really been, a big hurdle to overcome. Are you guys utilizing Mortgage Coach at all to show the benefits of the temporary buy down? Because it seems kind of, depending on who we talk to, some people every single time, some people not so much. Just kind of curious if you guys are utilizing that technology specifically for the temporary buy down.
Yeah, you know what we have? It's actually come in handy a couple of different times. It's actually won me a deal. So
Nice.
Mortgage Coach is just kind of lays it all out for you visually for them to see. And so, it's worked with Mortgage Coach for sure.
For me, Chris, it's a hit and miss. So I've got clients that, if you ask me, do they use Mortgage Coach? We'll be lucky if they have an email. So it's a 50-50, right? So I've got clients that have the ability to really appreciate the Mortgage Coach spectrum and that kind of business. But then there are those who just have no idea. But we are using it when we have to, 100%. Now, every single person is different. So what I've been doing lately, and it's really working for me, I include Cole, I include myself, and I include the borrowers in the same text thread. And in that text thread, I'm breaking everything down. And I'm also stating things are subject to change here, guys. Until we lock, then there's no more changing. It'll be good from beginning to end. So that text thread conversation has been a win-win for us, man, because I go back to it and then I said, no, here's the conversation conversation we had. And it's dated, and it's, I mean, it's for me, it's working out. I don't know if other people are doing it, but it's actually working out quite a bit.
Nice. What about in terms of funding the actual buy down account? Are you guys, because it could come from the seller. I mean, that's most popular, but are you explaining to the realtors that it doesn't have to all come from the seller? I mean, if you guys kind of want to pitch in, the agents can contribute too. Are you guys having that conversation? And if so, the ones that you've closed, Tony, has any come from the agent, or has it all been the sellers so far?
The last one that we talked about, both the realtor, the buyer's agent, myself, and the seller contributed.
Love it. Perfect. Because a lot of especially the newer loan officers that are just kind of starting to talk about this, lots of times they do forget, and it doesn't have to be all on the seller, like you said. So that's great. It can be a combination, of all three.
And because it was introduced late, I mean, this is what I said, what's right is right. We will all be contributors, including the buyer's agent. And so I had to talk to the buyer's agent, get her okay. I said, we're going to both go halfway in it, whatever we need to do. And then that seller is going to contribute the larger portion. How do you feel about that, Tony? Whatever it takes. So it's just communicating, man.
Yeah.
I was just going to say, I know earlier you mentioned or you asked about, any concerns from, buyers or agents. I've got some pushback from some realtors because they're always a little worried, in regards to their seller. They're worried they're going to rock the boat, so to speak. And so, I let them know, like, hey, there are three costs now with doing a loan. There's the down payment, there's a loan closing cost, and now there's going to be a seller credit for whether it's going to be for the buyer's closing cost or the buy down. So I'm trying to have them work this into their initial consultation with their seller. Like, look, you're more than likely going to have to give up some seller credit to make this transaction work. And I've also let them know, like, hey, you know what? If the seller's unwilling, the seller is not the only one that can contribute. It could be you as the realtor. That'll usually steer them to work this into their conversation.
Right. Right. Yeah. I mean, and that's a good point. That kind of goes around to just really being a good communicator and explaining to all parties. It's like, listen, everybody benefits much more with the seller credit to fund this temporary program, or buy down rather, than a price reduction. A lot of people that don't know about this program, they just lead right off the bat with the price reduction. And again, if you explain it properly, it's just much better again and more beneficial to all parties, with the seller credits or, agent credits to fund the temporary buy down. One of the things too, kind of going back to Carl, what he's been doing is actually talking to listing agents and coaching them on the verbiage on how to put their listings, offering seller credits right off the bat. And he's been helping them. So like I said, Carl probably more than anybody is so all in on this program. He's really taking it to the next level, coaching listing agents and stuff like that, which I thought was very cool.
That's interesting. I'm going to work that into my process because that's what should be done, right? It's just like, hey, let's lay it out on the table right now. And this is how it works.
Yeah, exactly. Yeah, I love it. And I didn't even think about that. And when Carl brought it up, I'm like, I mean, that's great. Why wouldn't he do it? It's just one of those things that, doing the extra effort, that's going to pay dividends, in the future, just being a coach, a consultant. I love you guys are really embracing the program. I love, Tony, that you're yelling and screaming at open houses so everybody hears you about the temporary buy down. One of the last things that I wanted to ask you guys, for people that, either newer loan officers in the industry, or even loan officers that have been around that are hesitant to talk about the program or for whatever reason, any advice or anything that you can tell them to make them a little more confident to even bring the program up?
100%. We have a few. Obviously, we got Matt, we have Ramon, and we have a newcomer, Josh Hodges. Those conversations have continued. Both Jeff and myself, we talked to them about their specific concerns. So Josh is just coming into this picture with our team, and he's like, dude, how are you doing it with high rates? And we both tell him, Jeff has his way of talking, I have my way of talking about that 2-1 buy down, and say, look, man, you got to embrace what's out there in the marketplace. You can't run away from it. Embrace the fact that rates are high. Embrace it, love it, enjoy it, and then talk about what we're doing to tackle. I mean, what we're doing to combat that part, right? So we got to educate the client. We have to educate the realtors. We have to educate our LOs, especially our new ones. And even our older ones. We're so used to doing things the old-fashioned way. We got to learn. We got to always adapt, because if we're not adapting or adopting new ways, we're staying behind. Plain and simple.
Love it.
Yeah, you know what I would say to that is to any new LOs is, just learn about the program, learn the ins and outs of it, post it on social media, but it's an excellent program to use and, use this to connect with potential referral partners.
Exactly.
This is an easy, you can use this for office visits. You can, you drop off flyers. This is one way to connect with potential realtor partners that maybe you don't know how to approach them.
No, it's just another thing, even if you don't end up, doing the program for a client, it's just a great segue to getting in front of people and talking to people. So I agree 100%.
Exactly.
I'm glad you said that because there are people in the open houses that they're like, I'm already approved. Thank you very much. And I'm like, wonderful. I'm so glad you're approved. Has your loan officer talked to you about the 2-1 buy down? No. What is that?
That's awesome.
Guys, I'm telling you right now, they haven't come to me, but they've texted me and they've called me. They stayed with their loan officer, but here I am, not even their loan officer, and I'm educating them. So maybe they're not doing the loan with me, and that's okay. I'm not here to steal your client, but I'm here to educate anyone who wants to be educated.
Yeah.
And that actually shows, the value to the realtor partner that you're doing the open house with.
Oh, yeah. And that's one of those things, again, just being the communicator, the educator, the advisor. Even if you don't get that deal, they're going to give you a buzz the next time and say, hey, Tony, talk to me more about this program. I know I didn't go with you last time or, whatever the case is, but no, that's great. I love it. Well, hey, guys, great commentary. Again, I really appreciate the time. Well, hey, Matt, thank you very much for taking a few minutes with me today to talk about the temporary buy down program. We're starting to see more traction, as a company. And what I wanted to do is just touch base with a few different branch managers in different markets and, kind of see what's working, what, might not be working. I know you haven't closed one yet, but I do see that you have looks like a 2-1 buy down in the in pre-approved status, which is good. Maybe to start us off, you can kind of just let me know maybe some strategies or what you've been doing to even bring up the program to start talking about it with agents or borrowers initially.
So thanks for having me. Happy to be here. Basically, with how I kind of have approached this, I certainly bring it up to agents because first off, if we're not bringing it up, it's not like they're under a rock.
Yeah.
They're hearing about this, whether it was from the World Series, right? Rocket Mortgage was advertising all over the World Series a 1% buy down directly to buyers that they were going to cover.
Yeah.
So it's been very much pushed, especially heavily by the real estate market and mortgage lenders right now as this, hey, it's not so bad. Don't just hide under a rock. Why don't you do this?
Sure.
So a few agents I didn't bring it up to then brought it up to me and said, hey, Matt, have you heard about this? What an awesome thing. For lack of anything else, I felt like the program, I haven't done one, as you mentioned yet. I've certainly pitched it and quoted it. But when I've gotten around to actually helping clients do it, for most of my clientele, which tends to a lot of times be first-time home buyers, it hasn't been enough to help them to get over the hurdle of qualifying, right? The issue that I've found with the program is it's being used in many ways as the replacement to, 06 and 05's interest-only loans, such as, hey, do a 5-year or a 10-year interest only. We'll qualify you at this. Here's the subprime market to help you get into homes. And while it's a Band-Aid, that's all it is, right? We're still qualifying these individuals at, 2% higher interest rates. And the simple fact is that a lot of people are finding that, hey, you just don't qualify. I just can't get your numbers there. So it's been really useful as a motivator,
Sure.
kind of to lift my agents out of the doldrums of, oh, woe is me, everything sucks. I wish I was just in another job. We're all going out of business. That kind of attitude that felt pretty heavy throughout at least my communities and with my agents, really from, mid-September through October. It was pretty depressing, as far as the marketplace went. We had calls, the calls that were coming in weren't qualified. And as soon as we told somebody, hey, yeah, here's your payment, it's, $5,500. And they went, well, we were really hoping for $3,500,
Sure.
right? So it didn't bridge the gap enough to really motivate those clients to taking the leap that I felt, especially specifically being in a more rural family-oriented community where we have more first-time home buyers. And then additionally, we have more people that are looking to move up from, the city area out rural, out more suburban to try to take advantage of cheaper prices. So to that extent, the motivation was, hey, agents, let's talk about this. By the way, if your client's just a little bit gun shy, we can make this work. But I don't bring it up to buyers specifically unless the agents brought it up or anything, because the buyer can't pay for it, right? So the other thing that I found with the program is if I go and pitch this to my buyer, well, I'm signing up for somebody else's money to be spent. And either I'm having to try and come up with that much money in the interest rate, which really isn't possible for a 2-1 buy down. We just don't have enough margin to go and say, yeah, the lender's going to cover it. So that really leaves that either my agent or my seller has to make up the difference. And thankfully, we're only just now really seeing that market turn, at least again in my rural San Diego marketplace, where we're seeing sellers say, okay, we need to be more aggressive. We need to start issuing the seller credits again. And we're coming back to that. The last 2 years, that's been pretty dang hard to find, right? You tell an agent that your client needs a $10,000 credit and they come back and say, you understand your client has to pay over asking price for this house. The seller's not going to entertain this. So I think that pendulum swing has swung more to the line where right now we can get this done. And specifically where I am pitching this is when I go and offer my listing agents, I offer them open house flyers, right? And we try to push pretty hard that we want to provide those. So we'll have the conversation. Hey, this is what these numbers are going to be. If your client's trying to sell this house at $1 million, if they're prepared to buy the interest rate down to, 5.75, which has been the, kind of a talking point number. Well, right now today, I just priced that and it was coming out at about 2 points cost with a 15% down program. So, okay, the seller's got to figure out that they may need to be buying it down to that anyways, just to be kind of where the jumbo markets are and where interest rates are to the point where I'm finding that clients are, hey, we're not in the sixes. We can be happy about that, having, heard in mid-October and early October, we were in the sevens. Right. So I think that the 2-1 buy down program has certainly been a good push. It has been a good tool to have. It has certainly been a very valuable talking point. And then most of the time what I've done is when I go and I compare, hey, this is what we can do from a 2-1 buy down, or this is what we can do with a full buy down. My clients have leaned towards taking the full buy down, the permanent buy down, for whether it's been because of the tax benefits of that, or whether it's simply been because the 2-1 buy down comes with, hey, in 2 years, if you haven't been able to refinance, you're going to have your bill's going to go up. Right. So I really like, though, that it has shifted the marketplace from a seller expectation, because the program is now so widely known and out there, that sellers are kind of going in many ways, pricing in that they're going to have to be doing something like that anyways.
Yeah, no, that's a really good point. What's been working well with some of our managers is they've actually been coaching listing agents on how to list the property, letting them know about the temporary buy down program, kind of lead off with, hey, we're willing to do seller credits up to X. And it's been working out pretty well from that front, just working with listing agents as well. And yeah, it's interesting too that it sounds like, at least in your area, because it's different, every branch manager I talk to, it sounds like up in the Ramona area, people pretty much understand what this program is. I mean, if realtors are bringing it up to you, it doesn't sound like you're having to explain from the ground up, maybe kind of fill in some gaps of how it works. But it sounds like, like you said, people have been talking about it out there for a little bit now.
Yeah. And I do tend to work with brokerages that have been a little bit more established. I have most of my agents have been around since at least before the '08 crisis, and a lot of them back into the 90s, where this was a more popular program.
Yep.
So, we didn't reinvent the wheel with the 2-1 buy down, right? Temporary buy downs have actually, they've been on the Fannie and Freddie guideline books for a while. So this was really just kind of an old tool that was pulled out of the hat to say, wait a second, we can pull this back. Similar to how we're now having conversations about VA and FHA assumptions again. Sure. Well, that's not new, but I just had one of my buyers call me on that and say, Matt, what's this? And I went, yeah, it's a great program. Good luck. To that extent, though, I've certainly had to pitch it to my junior agents and the newer agents in the offices to explain what this is. But frankly, my newer agents don't do a ton of business, right?
Right.
Where it has been a very useful tool, and the clients that have been more interested in the program is actually on investment properties. I've had quite a few investors with specifically one of my agents who does predominantly investments, where the investors have come and said, okay, well, I know I can raise rent 10% per year. So that 2-1 buy down actually gives me a little more time, if we can do it and make it work, to actually try and get the rents raised before the payments go up, right? Because they're kind of looking at it as, well, okay, my cash flow is here and then here. So there's been a lot of talk on that side of things, and I've seen more traction there. But then again, those are fairly savvy individuals, right? And to some extent, the 2-1 buy down program, you need to be fairly savvy, otherwise the other catch too is, where I've lost a few is, well, why don't I just go take an adjustable rate mortgage? And that's our biggest, I'd say, selling against it
Mhm.
is, going back and figuring out kind of, hey, what works for pitching, why you should do this over why you should just go take a 5-1 arm or a 5-5 arm.
Yeah, I mean, that just kind of goes back to, being a consultant really, and being a good communicator, which, I know you are. So yeah, that's a very good point. Let me ask you this, Matt, for, the times that you have been talking about the program, you think the temporary buy down would be a good fit for a buyer. Have you run into any common concerns or objections from either, buyers, agents, or even sellers?
A little bit. I have found that some buyers agents, as I said, I don't try to bring it up to the buyer first
Right. Yeah.
because, that puts me into the position of, in many ways now, I'm kind of steering a contract, right? I'm now getting involved in the negotiating process because I'm signing up for, hey, if you call your agent and tell them about this 2-1 buy down program, the borrower brings that up and says, hey, Matt was saying that we can do a 2-1 buy down, but you have to get me this much money.
Yeah, sure.
Right. That
Yeah.
goes across, now I've just created in many ways a hostile relationship with the agent. So I don't typically approach it that way. I will approach it with the buyer when the buyer brings it up to me or when I've already talked to the buyer's agent. So typically what I'll do is I'll take my pre-approval, and if the client's already aware of the program or mentions they've already had another lender pitching it, right? At that point, I can basically try to sell against that. Well, I would go in and say, hey, well, you just got to be wary because you're not allowed to pay for this. So really, when the seller or the agent has to do it, your agent's kind of pitching, you must go get this. And so if you don't write your contract the right way, the whole thing's, it's basically just been a bait and switch to you.
Got it.
So
Yeah.
I have sold and actually used that to get clients, from other lenders where they've gone and said, yeah, the agent was saying he's going to get me this interest rate. And then we went, well, wait a second, he quoted you a 2-1 buy down, but you didn't realize that required $10,000 from the seller and you weren't building that into your offers. That's, sloppy loan officering. So in that case, I've used it as an aggressive tool that way. And then again, I'll go to the agent and say, hey, want to meet up with you, just did the pre-approval. These are the kind of the numbers we discussed where discount points buy them. Want to get your feel on whether or not you think maybe we should pitch a 2-1 buy down. And then typically at that point, the agent gets, yeah, let's do that. We want them to buy the house. Definitely. I think in this marketplace, I can get them that seller credit. The other thing that we have to keep in mind is that it really depends upon the client. When we're doing a 5% down payment, that means that we're going to be borrowing 95% of the loan amount, which means that we're going to be getting a 3% on 95%. Whereas on the flip side, if I've got a client putting 40% down, now that, that seller credit, which is based upon the purchase price, that 2-1 buy down's a lot cheaper from how much can we ask for this from the seller. Right. I can get a lot further with the lower loan amount kind of situation. So I do feel that it very much differs based upon your specific buyer and their specific financial concerns.
Right. No, that's a great point. In terms of where the money is coming from to fund the temporary buy down, certain markets, real estate agents I have seen have been contributing. I mean, I know you technically haven't closed one yet, but just in your conversations, does it seem like the agents that you're working with, should you get a couple of these in the door, would be willing to contribute, or is it that they're just going to lean 100% on the seller credits?
Very hit and miss. I would say that I've got one client right now up in the Orange County area. They're looking at roughly $1.1 million to $1.2 million.
Mm-hmm.
And we've discussed the 2-1 buy down with them. The client actually leaned against it, saying, I'd rather just pay the discount points because, especially in their marketplace, they're looking at, well, I'll use the seller money to pay my closing costs and I'll use my money to pay my discount fee. That way I get the write off the discount fee and, they're at a 50% tax bracket.
Mm-hmm.
So, but from there, their agent's giving, $5,000. They said, hey, I'm going to give you $5,000 of my commission. All good. That helps. But at the same time, 5Gs isn't going to cover, 1% of an $800,000 mortgage payment. In that kind of situation, I'm seeing that it's pretty much necessary to some extent that we get at least a seller credit, combination.
Right.
Especially as, we're starting to see some of these, I hate to say this, but really some of those commissions are starting to get a little bit, a little on the lower side.
Right.
I saw one the other day, but they were only going to pay the buyer's agent 1.5%. So it's already been 5%'s come to be fairly standard, at least in the Ramona and I would say the San Diego marketplace overall.
Mm-hmm.
So if your buyer's agent's getting 2 to 2.5 of that, at some point they just go, okay, how much of this do I want to give up?
Right.
Most of the time they don't want to give up a full 1%. So if we're picking up, $7,000 out of their, $20,000 commission, let's say, I'd say they're being fairly generous in that situation. And so typically I would say to answer the question just briefly is, yeah, we're seeing that we need seller credit. It's being pushed at least initially fully onto the seller in contract with a little bit of the agent contributing.
Yeah.
And
no, that
again,
makes
depends.
sense.
A lot of it, again, as we said, depends upon what the loan amount is. If we're borrowing 95, which again, most of my clients do tend to be in, I do a lot of mortgage insurance transactions. That's something where we see, wait a second, you're getting a 95, 85% loan to value, a decent chunk.
No, absolutely. Now, I don't think you've ever been the biggest mortgage coach guy. Correct me if I'm wrong.
You are accurate.
But I know you're starting to adopt, more technologies and things like that. Just in the past, few months that we've been chatting about different things. It's funny in some markets. It's seemingly that every single time loan officers or branch managers talk about the temporary buy down program, they're always throwing out mortgage coaches, but it's usually in markets where the borrowers and even the agents aren't really familiar at all. So it's just an easy way to kind of show them. Do you think, and again, I know you just have one pre-approved, but in the future, do you think you might be leaning on mortgage coach, or do you feel in your area, people have a fairly good idea of how it works? So it's easy enough for you to just explain rather than firing them off TCAs on different scenarios.
I'm pretty good about explaining that kind of a thing, over a phone call, which is how I typically handle this kind of stuff. Or what I'll do is, and it's a ton of work, but I'll literally write out, hey, here's your interest rates from 5.125 all the way through 6.375 in a bulleted email, right? I want you to be able to very clearly see this. One of the issues I've always actually had with mortgage coaches, it only gives 3 options, if I recall correctly. So I'll go to do it and then find, wait a second, I can't actually showcase every loan structure that I want here. I kind of have to pick the ones that I want to pitch and what I want to show. I do think from a comparative analysis form, right, of looking at the different options, it makes it very easily visual for a client to say, okay, this is my bill. But again, I can pretty easily do that over the phone where I say, great, if your payment was 1% less, this is the savings you get for that first year. It's not really hard to wrap your mind around the idea that, hey, the seller's prepaying some of your interest so that you don't have to pay it. And that's going to end up with such and such a reduction in your payment for the first year. And you're betting by taking a 2-1 buy down that you're going to get to refinance in the first 2 years. That's really the reason to do it. Because if you think rates are just going to get worse, well, then do a permanent buy down.
Yeah, no, that's a good point. And again, like you said, it's just one of those things where if you at least know about it and you can get in front of agents and buyers, it's just up to the loan officer to be a consultant, just kind of go over all options with the borrowers.
And to feel what your clients are wanting in your marketplace, right? Every market's different. We all deal with different agents, different buyers, different walks of life, and people have different risk tolerances. So, some people would just never consider taking adjustable rate mortgages. They just go, no, I'm anathema to it. I'm not going to go down that. I'm not gambling with my house. And you have other individuals who, on the flip side of things, are saying, hey, I want interest-only loans 100% of the time. Just kick the can down the road. I don't care. Leverage it to the max. Keep the payment as low as you can get it. Okay? Where do you fall in the spectrum? And being able to address and give them all of the options and consult through all of the options, because anybody can just pitch, hey, here's my 3.25% interest rate. That was easy, right?
Yep.
That was just low-hanging fruit for the last 2 years. I think at this point, it's really getting back into the mortgage consultant and being that, in some ways a financial consultant based upon mortgages and where their lives are going to be and where you think they're going to be in 5 years down the road, and having those conversations and having this program be part of your arsenal and your tools that you can pitch and explain the benefits and the downsides and be upfront. Our industry is full of people and we have a reputation, unfortunately, for bait and switch and being unscrupulous. And, bankers aren't exactly loved in the United States. I wouldn't say anybody ever went and said, oh, good, my son-in-law's a banker. So we kind of, go, okay, how do we overcome the stigma that we're up against? And it's always by being forthright and knowledgeable. And again, this is just one more thing that if you're not knowledgeable about, somebody else is.
Yeah, and that's again, Matt, one of the reasons that I've been making these calls to branch managers, even if they haven't closed a bunch, they have a very good understanding of the program. That kind of brings me into one of the last things I wanted to talk to you about. Like I said, we are gaining traction, but what advice or words of wisdom would you give to either newer LOs at RWM or just loan officers that for whatever reason are hesitant to even bring up the temporary buy down program? Any thoughts on that or advice you might be able to throw out there for for them?
Yeah, I would say, research for yourself, crunch the numbers, play with scenarios, jump into Optimal Blue and run some things, read DU guidelines. I mean, I've always said, let your knowledge sell your experience. Let your knowledge sell why somebody should use you. For example, I haven't done a Cal half alone in, I think now 14 years, and I'd like to keep it that way if I'm being completely honest, but that doesn't mean I don't go research the program because it gets brought up to me. Especially, a good example was that build program that they were doing where everybody went, oh my God, they're going to give me an ADU?
Right.
Well, guess what? I have to know about that before it comes up to me, because when the client asks me about something, I'm expected to have the answers. So if you go, I don't like that program, that's fine. That doesn't mean you don't have to have it. And it's certainly fine for you to go and use that as your sales pitch of, hey, you know what? You're probably hearing a lot about this in the marketplace. So let me just take a second to kind of tell you more about this so that you're prepared to deal with it when your client asks you about it. Yep. And that's how I approach it in those kind of situations. I'll do this, and I do the same thing with most of the programs that I'll discuss. For example, especially the last, 6 months ago, right, when Mission Fed had the really aggressive 5.5 rates, agents were calling saying, why don't you have this? I had to be able to talk to that, right? I had to be able to come up with a solution and an answer as to why I don't have it, what the downsides were, and why a client might potentially want to use me instead. So again, even if it's not something that you do, even if it's not something that we have experience with, for example, I haven't done one yet, I still have to be able to present myself as an expert in the field and an expert on the program. And that goes for everything.
Yeah, you're 100% right. And it gets old pretty quick if every other question an agent, a borrower asks you, if you say, yeah, let me get back to you on that. It's like you're like you said, you need to be very well-rounded and have a general understanding of everything that's out there.
Yeah, I mean, frankly, one of my little catchphrases when I'm on the phone with clients and they say, hey, I got one more question for you, I respond with, I got all the answers.
I love it.
Do I have all the answers? Nope. And if it just happens to be one of those questions that I don't, I come back and go with, you know what, that one I'm going to have to get back to you on. I got to confirm. But again, they expect us to have all the answers. That's what they want to hear. They don't want to hear, yeah, you know what, I'm not sure about that actually, or I haven't heard about that program. Sometimes we have to say that,
right?
But you better darn well go do your research so that the next time that comes up, you don't.
100%. No, that's really good commentary, Matt. Yeah, I mean, I think we ran through pretty much all of our talking points. I mean, unless there's anything else that you can think of that, might be beneficial to, the LOs out there that, just, again, aren't feeling comfortable, or, even the people that are doing them. I love having these calls because there's different approaches. Like you said, each person has kind of different approaches. So it's going to be really beneficial for everybody to kind of listen to everybody's, commentary and how they talk about the program.
For just LOs in general, we got to stay positive. And the ways and this is one program that helps us stay positive. Mm-hmm. It's one thing that's like, okay, well, it's not great. It's not an actual 3.5% 30-year fix that, what somebody really, really wants, but it's as close as I can get right now. So, keep up with it, keep up with the news. Research is a large part of our job, mm-hmm. whether it's researching new programs, whether it's researching economic trends, whether it's having answers for, geopolitical things going on, because those can move interest rates. Our job in many ways is to be experts and advisors. This is one more thing that you just have to become an expert and advisor on, regardless of whether you ever do one.
Well said. All right, Matt. Well, hey, as always, I love your commentary. And again, thank you so much for taking some time to chat with me today. And yeah, like I said, this is going to be super beneficial. So thanks again.
Always happy to do it.
All right, buddy. Talk to you soon.